the outlook for the U.S. economy and monetary policy. Thank you, Andrew, and thank you for the opportunity to speak here today. I am very pleased to be talking here at the Weidenbaum Center. As an economist currently working on policy, but with a long trajectory in research, I particularly appreciate the center's multidisciplinary approach to building bridges between these two applications of economics. The Federal Open Market Committee, FOMC, has been working to lower inflation in the context of our dual mandate of maximum employment and price stability. Today I will discuss economic developments in the U.S. and how I view the current stance of monetary policy in light of recent data and longer-run trends. Since I am an economist, you will not be surprised that I will talk about recent economic developments by highlighting the dynamics of supply and demand. Major forecasts, on track. The economy has continued to show resilience and neither the ECB nor the Fed is ready to start rate cuts. We continue to expect the first ECB rate reduction in June, followed by the Fed in September. Our profile for euro to US dollar is broadly flat. The Swiss National Bank may have cut rates a bit sooner than many were expecting, but the Fed and the ECB are not there yet. The ECB signals have become even clearer than before in pointing to a June rate cut, while the strength in the U.S. economy coupled with a rebound in inflation and positive signs from the global economy will keep Powell's hands off the rate-cutting button for now. We keep our baselines for both the ECB and Fed unchanged. Fed's Kugler says lower rates this year likely appropriate. Inflation could moderate further without a significant cost to jobs or economic growth this year, setting the stage for some cuts in borrowing costs, Federal Reserve Governor Adriana Kugler said. Weaker consumer spending should help slow economic growth to below last year's 3.1% pace, Kugler said, and demand for workers is easing as well. With demand growth cooling, given the backdrop of solid supply, my baseline expectation is that further disinflation can be accomplished without a significant rise in unemployment, Kugler said in remarks at Washington University in St. Louis on Wednesday. Building approvals, Australia key statistics. The February 2024 seasonally adjusted estimate. Total dwellings approved fell 1.9% to 12,520. Private sector dwellings excluding houses fell 24.9% to 3,771, while private sector houses rose 10.7% to 8,404. The value of new residential building fell 19.1% to $5.79 billion. The value of non-residential building fell 16.0% to $4.09 billion. The seasonally adjusted estimate for the number of dwellings approved fell 1.9%, after a 2.5% January fall. The trend estimate for total dwellings approved fell 3.0%, following a 2.7% January decrease. Currency Angst is going global as strong dollar vexes markets. Bloomberg, a resurgent U.S. dollar is exasperating central bankers and governments around the world, forcing them into action to relieve the pressure on their own currencies. From Tokyo to Istanbul, policymakers are stepping in to defend exchange rates with both words and deeds as a resilient American economy conspires to keep the greenback strong by pushing back expectations for lower U.S. interest rates. The greenback has gained against virtually every major peer in 2024, defying many on Wall Street who came into the year predicting a dollar sell-off. That's prompted escalating warnings from Japan on its readiness to intervene to buoy the yen from near a 34-year low. Turkey blindsided markets with a rate hike to boost the lira. China and Indonesia have moved to steady their currencies, while Sweden and India are also under pressure. Thank you.